Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. We're recording this interview on Friday, August 8th, 2025. The US dollar gold price has rallied substantially over the last couple weeks. I think it hit yesterday or the day before $3,500 briefly. It's a little bit below $3,400 when we're recording this interview. The gold miners have started to report the Q2 earnings for 2025, and we've had some nice upside surprises. Today's special guest is a returning guest. He's been covering the gold stocks for a very, very long time. He's an asset manager and also a newsletter writer. Adrian Day, thank you for joining me again.
Well, thank you, Jason, for having me back.
So, Adrian, we were just starting to get the Q2 earnings for a lot of the gold miners. Newmont Mining had a huge upside surprise on free cash flow. The Wall Street analysts were expecting around $650 million of free cash flow for Q2 for 2025, and Newmont Mining beat it by 1.7. The total amount of free cash flow for the quarter was 1.7 billion. Are we seeing similar types of earnings beats, and free cash flow from the rest of the gold mining industry?
Yeah, we are definitely. Those that have reported so far, you look at, Agnico, we're used to Agnico beating, right? But Agnico earnings were 194 a share with the estimate of 160 per share. I mean, that is just a huge beat. And of course, they had record free cash flow, as you would expect with the price of gold where it is. Newmont was interesting because, of course, Newmont, how can we put it delicately? We're not always accustomed to Newmont beating guidance. So I think this is a clear sign. And look, let's look at it. Let's look at gold over the last 18 months and just look at what the average price in the second quarter was. I mean, if a gold mining company, absent any particular extraordinary event, if a gold mining company can't have good cash flow in the second quarter, then they're clearly doing something wrong. So in a way, it's not a surprise, but yeah, we're seeing this with many of the companies across the board.
Yeah, some big beats. So I think Newmont's at a 50, maybe a 52-week high or close to an all-time high. It's finally starting to break out there on the stock chart, on the max chart. Have you seen gross profit margins at these levels? Because aren't we at like 55% or 60%, somewhere in that range for gross profit margins for the gold mining industry?
Yeah, the profit margins are just astonishing. And in fact, the margins for the gold mining sector have expanded very dramatically over the last 3 years. If you go back, a few years ago when gold was at, 1,200 or something, and the all-in sustaining cost was 900, I mean, that's still a nice margin for any normal business. But now we've got all-in sustaining costs, anywhere from 1,350 to 1,750. Basically you've got a 50% or better profit margin and pretty much across the board. And the gold mining industry has the largest or the most rapid growth in cash flow of any sector in the S&P. So yeah.
So you're saying like the generalist investor, so like a hedge fund or a trend follower, is noticing what on their Bloomberg screens that the gold miners, you said, have the most free cash flow growth of any industry?
Yeah, well, the second part is true. The most cash flow growth of any industry. Is the generalists noticing it? I'm not sure they are. I think at some point and maybe the second quarter is when they'll finally wake up to it. The generalist investor is so focused on the Magnificent Seven at the moment. And of course, the S&P is going up month after month after month. So they're just not looking at other sectors. In my experience, but I think that's beginning to change. And certainly the free cash flow that we're getting out of gold miners just has to get some attention. It has to.
Are we at the stage in the bull market now, Adrian, where the laggards, say like an SSR Mining or some of the mining companies that have operational problems but good assets, where some of these other mid-tier producers that have better free cash flow margins, they're going to start to say these assets are cheap, we're going to go buy those assets and turn the operations around at some of the mines? Are we going to see more mergers and acquisitions like that?
I definitely think we're going to see more, but I think we always I think investors generally overestimate the number of transactions and the speed with which they'll take place. I mean, yes, so I definitely think we're going to see more. But, a lot of companies, I mean, Newmont, they're still digesting the Newcrest acquisition. Agnico has plenty of in its pipeline. Um, Barrick's not really interested in M&A, but, they're focused on building Reko Diq in Pakistan. So all these companies have enough on their plate at the moment. And so even though they're definitely looking at M&A opportunities, I don't think most of them are in a great rush. I mean, if you've looked at M&A over the years, sometimes you see something that just makes sense. It makes sense for company A to buy company B, but it goes on for years and years and years before they finally do it. And typically for the acquiring company, particularly if they're a big company like Barrick or Newmont or Agnico, they seem to be less interested in striking at a particularly good price, getting the best deal they can in the acquisition, but they're more focused on doing it when the time is right for them. When they finished a new construction and now they're ready to take on something else, or when the mill is beginning to see lower throughput, and so they need more throughput into a particular mill. They seem to be much more focused on when the time is right to do it rather than when the price is right. That's
Are we seeing more like joint ventures or investments, say from like a senior gold miner or a mid-tier one into a junior where they earn 50% or more of a project? Are we seeing more of those joint venture deals instead of the mergers and acquisitions?
Yeah, we're seeing a bit more of that. I mean, we're seeing it across the board. I don't expect a mega merger like Newcrest, Newmont. I'm not expecting another one of those in the near term. I suspect we'll get more mid-tiers and intermediates joining up, like Calibre and Equinox. I think we might get more of those. But definitely we're seeing more seniors take an interest in juniors. Now, the interesting thing to me, Jason, is you mentioned earnings. One of the most active seniors on that front has always been Agnico. They have always had a very strong. They've had a lot of joint ventures and option earnings and so on. What's interesting to me is in the last few years they have switched away from option earnings to take an equity interest in smaller companies. And the benefit to that, or the advantage to that for the senior company, I guess, is that if you own 9.9% of a junior exploration company, you don't have much of an obligation. You're not running a project. It doesn't take up an awful lot of your management time, exploration time, and having these exploration meetings, designing the program, and then also putting the money into the exploration. You make an investment, and that gives you a seat at the table, if you like. Not necessarily a board of directors seat, but it puts you in a position where you follow the company, you follow what's happening, and you're in a position to strike when you think the time is right. Agnico, for example, believe it or not, just as a reflection of how active Agnico in particular is, but how active that part of a business is, their portfolio of investments in exploration companies is now worth over $1 billion. This is a huge, huge portfolio. And Amar Al-Joundi, the CEO of Barrick, the CEO of Agnico, on their call last week, he emphasized this is not an investment portfolio. We're not a hedge fund. We're not, buying stocks when we think they're cheap and selling them and trying to make some money. We bought these stocks. Every single one of them is an investment because we like a project they're working on.
Okay,
And
so it's strategy to get exposure to potentially acquire the whole project, then you're saying?
exactly. And if you're a 10% shareholder or 9.9% shareholder, you're obviously following it more closely than other people. And even if you don't have rights of first refusal or anything, you can strike when you think the time is right. you're just in a better position.
Well, the more aggressive in the gold space has been the royalty companies, the royalty and streaming companies, because you had Triple Flag, which paid over 300 million in cash for Origin, which was one of the companies that we've been talking about over the last 18 to 24 months. That was one of your favorite junior companies, was Origin Royalty with the discovery in Nevada, right, with Anglo Gold Ashanti on the Merlin and Silicon deposits, and then also Sandstorm Gold was just huge buyout offer by Royal Gold.
Yeah, no, huge. And of course, you're seeing Franco. Franco has bought the 1% of Altus's. It's called the Arthur deposit now, but the Silicon deposit. And then they recently bought 7.5% royalty on Cote, a legacy royalty. You just mentioned Royal Gold and that huge acquisition of Sandstorm. That's the largest single acquisition in the royalty space, in the history of a royalty business. And then right immediately following that, they paid $1 million cash for a stream on First Quantum's.
$1 billion, you mean? Yeah, I just saw the press release. It was $1 billion.
What did I say?
You said $1 million. Yeah, it's $1 billion. It's a massive gold stream. Yeah.
So, Sandstorm was all shares, of course, and this stream in Zambia is all cash. So, yeah, there's a lot of activity going on. One of the things that reflects and which it tells us is the large royalty companies have generated so much cash over the last few years. I mean, and particularly over the last year, they have generated enormous amounts of cash. They've got very strong balance sheets, typically, and the opportunities to deploy it are sort of getting fewer and fewer. So a lot of people thought that the Triple Flag purchase of Origin was expensive. I frankly didn't. I mean, I thought it was a great price for Origin, don't get me wrong, a great price. But I'm not sure that Triple Flag overpaid. Franco says they think that deposit has the potential to more than double in coming years. So, from their point of view, as an asset in the portfolio, they can be prepared to wait till it comes onto production. They got a reasonable deal as well. But I guess what I'm saying is, we've seen some huge deals, but companies have to start, being creative, if you like, to spend that money, and that gets us back to Sandstorm. Maybe now we're going to start to see a little more consolidation in the royalty business, which would certainly be overdue, in my view, particularly among the smaller ones. I think there's just altogether too many smaller companies in this space.
And not enough cash flow. I mean, some of the smaller ones have bought royalties over the years, over the last five to 7 years, and it wasn't on near-term cash flow assets. So that's been the issue with a lot of the smaller companies.
Sure. Sure.
But I'm actually surprised that Franco Nevada hasn't been more aggressive, and they didn't put in a competing bid for Sandstorm Gold or try to buy Osisko Gold Royalty to get that large royalty, the 5% royalty on Canadian Malartic. I'm pretty surprised Franco hasn't been more aggressive.
Well, yes. I mean, their attitude and their attitude has been, maybe it's changing now. Their attitude has been that if you have a company that's trading at 1.5, 1.75 times NAV, and you've got to pay a premium to buy it, that means you've got to pay 2 times NAV or even above 2 times NAV to win a transaction, to win an auction on a company. His attitude was, you might be prepared to pay 2.25 times NAV for, let's just say, the Malartic royalty that you mentioned, or the Caserones in the case of Sandstorm. But you don't really want to pay more than 2 times NAV for everything in that portfolio. That's been his approach. And I understand that, and I certainly see it. Sandstorm, of course, was acquired at one of the lowest multiples, at a multiple far, far lower than a Cisco and Triple Flag, let alone the big ones. Its multiple was a lot lower than that. But I understand his point that when you're paying a premium to acquire a company trading at a multiple, you're paying a pretty high premium to NAV on everything in that portfolio. And Franco, of course, traditionally, and we saw this with the Altius deal, they do not want to dilute. They do not want to use their paper, even though their paper is trading at, gosh, is it 5 times NAV or something? It's not cheap anyway. Yeah, basically it's 5 times NAV. But they don't want to use that paper and dilute. They prefer to use cash. And so, you know, you don't want to pay cash. You don't want to pay two times, more than 2 times NAV, unless you really, really like the assets. But
Sandstorm,
I think, sorry, go on.
well, you said Sandstorm was bought for pretty cheap, and I would agree. I think a lot of their growth assets were not priced into the valuation of the stock, even after the buyout price, but certainly before the buyout price, because they have the Platreef gold byproduct stream about to come online in the next couple of months, and that wasn't priced into the stock either. So, and the real gem that a lot of the larger royalty companies wanted, Adrian, was Mara, which is going to start construction in the next 6 or so months from Glencore. That's a 20,000 ounce per year stream, and there's about a 30-year mine life on that base metal mine.
Yeah, no, we did not own Sandstorm, I will admit, but I would have to say that Royal Gold struck at precisely the right moment before all these growth assets started to have more visibility.
Oh yeah, I agree. Mara is the real gem here that a lot of people aren't talking about, because I saw your newsletter update and you mentioned some of the growth assets like Hamadan and Platreef, and there's one on Oyu Tolgoi. Nolan Watson bought that one for $40 million, I think in 2012 or 13, and that thing's going to end up, once it comes online, the underground mine for copper, gold, and silver streams on Oyu Tolgoi, that's going to cash flow like $30-40 million a year, and he paid a one-time payment of $40 million back in 2012 or 13. So there was a lot of good optionality in the portfolio that wasn't priced into the stock, into the valuation, unfortunately.
Yeah, no, I think Royal Gold got a very good deal. I mean, a lot of the analysts immediately were saying, "Oh, this is a dilutive transaction," and you saw the reaction in the stock price. Some of that, of course, was just ARBs selling Royal Gold and buying Sandstorm, but nonetheless, the immediate reaction for Royal Gold shareholders was negative. But I think they totally misread it. You know, in 3-5 years time, that'll look like a really good buy.
Oh, especially with Mara. I mean, because if you do undiscounted cash flows for Mara, I mean, that's way over $1 billion in valuation for the Mara gold stream alone. That's at least 30 years, and they haven't even drilled off most of that property. That has 30 years of reserves on already. Huge gold stream. I know Franco Nevada had tried to buy that gold stream separately from Sandstorm Gold over the years, and Sandstorm had turned them down. So Royal Gold definitely wanted the Mara gold stream. If you look at the press release, that's like the first gold stream that Royal Gold and Sandstorm Gold mentioned when they talk about the acquisition was Mara.
Yeah. That's interesting what you say about Franco, though, because that's Franco's approach. If we see an asset we like in a company, we'll try to buy it, but they've been a little more reluctant to buy entire companies. That may change with the enormous cash flow that these companies are generating. I mean, you can always sit on cash. Franco has demonstrated, I keep saying Franco, but Franco's demonstrated they're not afraid to sit on cash for a long period of time. But at some point, you've got to put that money to work.
Oh yeah, I just looked up the deal because you mentioned it, that they bought almost all of the royalty that Altius Minerals has, what, on the Silicon deposit, Silicon and Merlin. So they paid what, 250 million in cash for it?
250 million US. Yeah. So 340 million more or less Canadian. But 250 US plus a $25 million sort of bonus if Altius wins their remaining arbitration against Anglo Gold. So yeah, that was a good deal. And for Altius, the fact that they had a 1.5% royalty, but the fact that they sold 1% and kept 0.5% was like a perfect arrangement for them, because it meant that it right-sized that asset in their portfolio, because Altius is not a gold royalty company. So having 40% of your NAV in a gold royalty, that meant that asset alone was sort of overweight in their portfolio, but they also were not getting the gold royalty premium because they're not a gold royalty company.
And it wasn't cash flowing either, yeah.
Yeah, so selling 1%, but keeping 0.5% as a long-term, so that's 170 million in their portfolio. That's a reasonable asset in their portfolio. But in 10 years' time, it'll be a very attractive cash flowing asset.
It just seems like the price and the valuation for those types of assets, it's going up and up, especially at a much higher gold price. Because I remember a couple of years ago what Royal Gold bought for 150 million in cash. They bought the royalty for Great Bear, and people were criticizing them. You paid 150 million for what? And it's how many years away from cash flow? I mean, now like that same type of royalty would probably sell for $400 or $500. It would sell for a lot more than what Royal Gold paid for it.
No, absolutely, absolutely. And again, that's partly a reflection, obviously, on the gold price going up, but it's partly a reflection of just the diminishing number of really high quality assets in North America, in my view, but for which royalties are available.
Well, is there a sizable royalty on the Blackwater mine that Artemis just put into production? Because I know there's a tiny royalty on the new spinoff, the Versamet royalty, but I think it's below 1%. I was wondering if anyone had a larger royalty on it.
I'm not sure, to be honest.
Yeah, so Versamet's like the new, it's a spinoff from B2 Gold and Equinox Gold and Sandstorm. So those were the only shareholders, other than now, I guess, Royal Gold. So that's like the new one, but I don't think there's any trading liquidity on Versamet yet.
Well, it obviously shot up quite a lot after it came out. Yeah, it's not the most liquid, but the funny thing is when you spend most of your day dealing in junior gold stocks, someone that trades 50,000 shares doesn't ring any bells as being illiquid. But for an institution, that would be difficult to acquire at this point. Yeah.
So I don't see a lot of tier one royalties, like you said, for any of the juniors, because anytime there's like a Great Bear royalty with a spinoff that has like a royalty on a really good tier one mine that a larger senior or mid tier gold miner bought and is going to develop, it seems like one of the larger companies, like a Franco Nevada Royal Gold, wants to go buy the tier one royalty pretty quickly.
Oh, sure. It's very, very difficult for the smaller ones. Very difficult because I mean, we all know the cost of capital for Franco and Wheaton and Royal is a lot lower than the cost of capital, even for a Cisco, let alone for Metalla and EMX and so on. And the cost of capital determines what you can afford to pay for something.
Now, one of the knocks I hear from generalist investors on the royalty companies is the valuation's high. They're not sure if there's growth. Are we going to see a lot more dividend growth and free cash flow growth? And do you think there's a lot more growth opportunities for the largest royalty and streaming companies for Franco Nevada, Wheaton Precious Metals, and Royal Gold?
Yeah, no, two questions or two answers. Look, if Ben Graham came back and opened his Bloomberg, he wouldn't use the Bloomberg, but if he came back and opened his Bloomberg and looked at the valuations on Franco and Wheaton, he'd probably throw his Bloomberg out the window. He'd run away. He wouldn't even consider those because they're overvalued. But having said that, if you look at Franco or Wheaton, the valuations of those companies are really only trading at their own historic averages. So by their own standards, they're not overvalued. And then the other thing I would say is that I think the business model, being so low risk and with a lot of optionality on the upside, justifies a higher premium, to be honest. I mean, one might argue 5 times NAV is a little high, and 60 and 70 times earnings is just maybe a little stretched. But I don't think they're grossly overvalued by any means. And I do believe very, very strongly that there's continued upside in the large companies. You look at Franco, for example, they've got royalties on over 400 non-producing assets. And I remember David Harquell, who's now the chairman, but when he was the CEO years ago, he said to me, look, we've got royalties on all these assets, but for the most part, we pay peanuts for. In many cases, they came with another royalty that we purchased. So we paid very little for them 10, 15 years ago. If the price of gold at the time we were talking, he said, if the price of gold goes up 50%, I can guarantee you that a dozen or more of these assets will start producing. I just don't know which ones they'll be, but they'll start producing. So that's tremendous leverage when you're sitting on all that optionality and don't have to pay another penny to get it into production. So I think there's an awful lot of upside in the senior companies. When you look at the junior ones, I don't agree that they are overvalued. I mean, I know there's always an argument, of course, about cash flow and near cash flow versus things that you have to hang around for a decade, before they come into production. But if you look at a company, for example, like Metalla, expensive on a cash flow basis relative to the other, relative to its peers, but trading at maybe a 60% of NAV. Now, a lot of that NAV is far dated, of course, but my argument will be, and I'm not focusing just on Metalla here, I'm just as an example, but my argument will be, as these assets that won't come into production for 7 to 10 years, but as these assets hit milestones, then that value will start to get highlighted or daylighted in the company. And again, just to look at Metalla, they've got a royalty on Copper World, which is a few years out now, but so does Franco. So Franco talks about Copper World on their quarterly calls, and that all, a Metalla, if you like, can bask in the reflected glory. You look at Taca Taca, which is one of their biggest royalties. That's First Quantum's mine project down in Argentina. Probably won't come into production for 7, maybe 10 years. But Franco also has a royalty on Taca Taca. So maybe not this year or this quarter, maybe not next quarter. But as milestones are hit, then Franco will start to talk about that. And again, that will all reflect down to the juniors. And the others are in similar positions. There's a lot of the juniors that have assets, but are good assets, real assets, but just not getting much value in the market right now.
And before Royal Gold made the acquisition or the bid for Sandstorm Gold, one of the knocks was they have a high valuation and they don't have a lot of future growth because they had the Great Bear royalty and they didn't have a ton of growth. Well, now once this acquisition goes through, I mean, like all the criticisms that people are saying, I mean, they're going to have an enormous amount of diversification and enormous amount of growth on a lot of the copper mines. I think that's the key for like Franco Nevada, Royal Gold, and Wheaton Precious Metals is they're going to have a lot of opportunities to buy gold product streams on those copper and base metal mines because like it just seems to me, Adrian, a lot of the banks over the last 15 years just didn't want to fund these copper mines and base metal mines.
Sure. So you remember, 10 years ago, in the period from 2012 to 2015-16, after the metal prices collapsed, you remember that the top two in particular, Franco and Wheaton, did a lot of streams with the base metal companies to repair their balance sheets and get the gold byproduct streams. So that was a great, great opportunity for them. You don't really see that quite so much. You don't see much balance sheet repair at the moment. You could argue perhaps that to some extent, the Royal Gold purchase of the $1 billion stream with First Quantum in Zambia was partly, to shore up their balance sheet. But you don't really see the base metal companies in trouble and needing that. But what you do see today is that streaming and royalties and streaming have really just become a standard component of a financing package, whether it's a expansion of an existing mine, whether it's a development of a project. Streaming is just an automatic part, a standard part of a financing package. And as you said, the banks have been, particularly in the last few years, have been very reluctant to invest in developmental projects in particular, maybe a little less so for expansions, but for developmental projects, they've been reluctant, particularly if there's any kind of jurisdictional risk. And so that's presented a great opportunity for the streaming companies to take their place.
Yeah, I totally agree. And China was funding a lot of these copper mines. So their state-owned enterprise mining companies like Zijin Mining with Ivanhoe, they were doing deals on building out these copper mines. Well, now the U.S. has listed copper as a strategic metal. There's tariffs on this. So there's going to have to be a policy change from the banks. Otherwise, there's just going to be absolutely enormous opportunities for the largest royalty and streaming companies to continue to do these byproduct streaming deals on the copper mines because it looks like a lot more copper mines are going to have to be built, especially in the US and Canada.
Sure, agree with you 100%. And I think we will see a shift. But, over time, the relative value, the relative attractiveness to the company, to the mining company of streams, debt, debt, equity, and the fourth alternative, of course, is to bring in a partner to actually sell part of the asset to a partner. But the relative attractiveness of those four ways of raising capital will change over time. So a year ago, 2 years ago, very few companies wanted to raise a lot of equity, because the shares were so low and there was such dilution. And the banks, as you know, were insisting, but if we lend you money, we want you to raise some equity as well. That's sort of shifted now, so that now it's a lot easier to raise equity this year, but it's also not so dilutive. It's not so unattractive for a company. So these things always, shift around and change. But again, from a point of view of the royalty streaming companies, I think they're just a standard part of a financing package now. And you've seen some of the deals that Franco and Wheaton. I don't think Roll's done it, but Franco and Wheaton have done recently, where it's a whole package. They want the stream, that's what they want. But in order to get the stream, they have given some debt and also given some equity. Invested in some equity as well in order to get the stream. And I think you're going to see a little more of that going forward as well.
Well, Royal Gold's also been creative here with some of the financing, and they put in what construction timelines and deadlines for contingencies. So if the project doesn't move forward, then Royal Gold doesn't, the mining company doesn't get the capital from Royal Gold, or the terms change. And Royal Gold's they've also restructured some streams in the past with Mount Milligan, right? Because that was too big of a stream and they had to restructure it so the base metal company could make a profit.
Sure, absolutely, yeah, yeah.
And
You're seeing a little more of that. I mean, look, the royalty streaming companies, they want the miner to succeed. If the mine doesn't succeed, they don't get their royalty. And so, being willing to renegotiate when a royalty is just onerous, it's just good business. Now, you don't want to make yourself appear too ready to renegotiate, or everyone wants to renegotiate. But certainly Royal has shown themselves ready to renegotiate, and Royal, and I think also Wheaton, has also been very good. Both of those two companies in particular have been very good at coming up with, terms, conditions, structuring to sort of to help. I mean, Wheaton, I think Wheaton was the first one to come out with the idea of having the other assets of the company as a backup if the one you've got a stream on doesn't come into production over a certain, at a certain timeline and over a certain minimum. So if you put a stream on Pascua-Lama, for example, Royal did this. If you put a stream on Pascua-Lama and Pascua-Lama doesn't come into production producing at least X number of ounces by Y date, then they're entitled to get those ounces from other assets of Barrick. And so you're seeing more and more of that to protect the royalty and streams. Yeah.
yeah, Sandstorm Gold was doing that too over the years. They started that in 2015 and 16 with Yamana Gold, with the Cerro Moro silver stream. So Sandstorm was getting paid from other silver streams on other producing mines from Yamana before they got bought out, before that mine Cerro Moro came online. So it's just
Sure.
creative. They can adapt. I think that's a huge difference between when the mining company is trying to get debt from a bank. I mean, the bank's not going to be as flexible with the debt if depending upon what type of debt the mining company is borrowing from the banks. If it's a revolving credit facility or some type of junk bonds or corporate debt or something like that, the royalty and streaming company is going to be a lot more flexible with renegotiating the stream than the bank will with debt.
Absolutely, 100%. And the royalty companies, again, they see themselves. I mean, Randy Smallwood keeps emphasizing this, but it's true of the others as well. They see themselves as a partner. So they want the mining company to succeed. And of course, they understand mining. They understand the difficulties. They understand the opportunities. So I think that, so yes, as you say, they're more willing and able to be flexible. The banks will tend to look at a credit to a bank, to a mine, the same way they look as a credit to any kind of business, with all of the traditional covenants on debt to equity ratios and so on, which may not be that critical for the mining company. So a Franco or Wheaton or Royal, they will understand the nuances a little bit better, I think.
So since we're at such a high gold price, I want to ask you about new gold mines or copper and gold mines that are under construction. Are we seeing a lot of really high profit margin mines that are getting funding that are already starting construction, or has it been slower than you expected?
Um, well, these things always take time, don't they? I mean, I think as gold investors, we always expect things to happen a little sooner than they really do. We're certainly seeing some mines with very attractive margins. But as we've seen recently with, let's say Goose Bay, and then with Greenstone, Equinox's Greenstone in Ontario, I mean, it's not unusual to see problems and delays and slow ramp ups, and even with good operators, that's not unusual. So I think it takes a while before the mines hit their pace, typically before they hit their pace, and we can see the big cash flows. But yeah, you're absolutely right. I mean, I think there's several of those that are under construction or have just completed construction, where the cash flows will be pretty astonishing.
Yeah, the one everyone talks about is Blackwater for Artemis up in Canada. But to add to your point there with Greenstone, what that was supposed to be producing 300,000 ounces of gold a year, it's not there yet. And that mine supposedly achieved commercial production, 9 or 10 months ago, something like that, towards like October, November of 2024.
Something like that. No, that's been a very, very slow ramp up, and very frustrating for the market. Frustrating is a nice word. Very frustrating for the market. But I think they're sort of getting there. They just put in a COO, I think, the chap from Calibre, who's got a very good reputation as an operator. So
Well, I
sorry.
mean, Equinox has been really aggressive. They've been the most aggressive, I think, of any of the gold miners, right, for acquisitions the last couple of years. I mean, they bought a lot of stuff.
Yeah, well, Ross Beatty, who started it or founded it, his goal was to reach 1 million ounce production within a certain number of years. So, I mean, it was a very aggressive program. And they've done a really good job. I mean, that's from a standing start. It's a solid mid tier now, but again, they do have these problems with the ramp up of Greenstone. Los Filos is still on hold. Los Filos in Guerrero province in Mexico, state rather, not province. Awaiting agreement from all of the local interests on restart in that mine. As you know, they just sold some of their small mines in Nevada to bring in a little bit of cash, which I think is a good idea, because I don't know, they had a couple of raises that the market wasn't expecting, both in debt and in equity. So selling these mines, what did they get? They got 115 million US for them. So I think that was a good deal, because they mean little to Equinox, but the cash will come in useful.
Well, in my opinion, Equinox added too many assets too quickly, right? Because they had to restructure their debt and add more debt when they got 100% of the Greenstone mine, 18 months ago? Because it kind of was surprising that the last 40 or 50% of Greenstone hit the market at the time, and then Equinox went and bought it. And then, 12 months later, then they bought Calibre or Calibre. So, I mean, they've just been super aggressive. Los Filos has been a boondoggle. You mentioned some of the delays. I mean, that thing was producing, I think they just put it on care maintenance 6 months ago. It was producing at over $2,000 an ounce. There was just immense problems with it.
Yeah, it was the largest mine. Um, no, I mean, I don't disagree with you. I don't disagree with you. But I
Well,
do,
I get messages from angry Equinox Gold shareholders.
I do think they're turning the corner now. I mean, raising this 100 million from the sale of the Nevada assets, that's a good deal. It gives them cash and it gets rid of a few small marginal assets that mean nothing, are just a distraction for Equinox management. Um, I wouldn't be surprised. Of course, with Calibre, they got the Valentine mine or the Valentine project that has the potential to be another, very, very good tier one mine in Canada. And then perhaps they could think of getting rid of those smaller mines that they have in Brazil. I don't know, and just focus on two or three really large mines. Los Filos isn't lost, of course, but they've made it very clear that they just do not want to come back unless they have, firm understanding and firm agreement from all of the local people, because it means lower, right? But the next phase of that mine going underground means fewer workers.
Well, I've listened to Greg Smith talk about this at length on the conference call, and they basically said they want to renegotiate the tax bill down before they invest like hundreds of millions of dollars in capex. But I don't know if they have the right political connections to renegotiate the tax bill down. So they said they're not going to invest the amount of capital expenditure required to get the cost of the mine down until they're assured that they can lock in a lower tax bill on the royalty tax, the government royalty.
Okay, I was not aware specifically of that. I mean, I think they are still working with they are still working with the local communities, but very clearly they don't want to. Very clearly, they don't want to spend the capital required until they have all of the agreements that they need, whether it's with the government or with the local people, to know that this is going to be a profitable operation. So I think they're right to be very, very clear and very firm on that.
Yeah, maybe they should just sell that project Los Filos to like Fresnillo, which is the largest silver miner in Mexico and also has a sizable amount of gold production. And Fresnillo could probably negotiate the tax bill down.
Right, right.
Yeah, because all Fresnillo does is operate in Mexico. So I actually do want to ask you about Mexico. Do you think that it's we're going to start to see more mining companies invest projects into Mexico? Or do you think that Mexico is still like it depends on the province, or is it just too risky now to make a large investment in a new mine in Mexico?
Well, I don't pretend to be an expert on Mexico. I mean, clearly you're right that the different states, some are more difficult than others. I mean, you saw the problems that Fortuna had with their San Jose mine down there in the south. But the new president. I mean, just a couple of months ago, she came out saying they weren't going to give any new permits to foreigners to build mines. She iterated that policy. I I still think most companies are cautious on Mexico. That's the sense I have. Both smaller companies doing exploration that were focused on Mexico are looking for opportunities outside of Mexico. And, even some of the bigger companies are just not wanting to get involved at the moment. I mean, it'll change, but the expectation of a more friendly mining environment when the new president took over uh, haven't really come to fruition yet.
Yeah, I
You
was told by another expert I interviewed, they basically said that there's not going to be any more permits for open pit mines. That, like, basically, if you already have a permit, you're okay. And if you were looking to get a permit in the next 6 to 12 months, the odds of you getting it in that time frame are very low, and it could be delayed years and cost tens of millions of dollars more. That's what I heard from someone else.
Right. Now that was for open pit, right?
Yeah, it just seems like
Absolutely.
they're anti-open pit mining for some reason.
No, absolutely. And she also said at the same time, no, you're absolutely right. She said no new permits will be issued. But they also at the same time said that the environmental agency was going to closely examine all existing open pit mines. And, one can only think they're going to closely examine them if they intend to shut down some of them.
Well, the local community wants the mines because a lot of these mines, Adrian, in Mexico, they're out in the desert, they're out in the mountains, they're in the middle of nowhere. And so the local town sprung up around the mine. So they want the jobs and they want the investment. But it seems like the federal government in Mexico City, they don't want this because what they're pro ESG and they're claiming how bad mining is, even though we still need the metals, right, for all these green energy projects.
No, absolutely, absolutely. And you look at a province like a state like Guerrero. I mean, you're either in mining or you're working for the drug cartels. Well, I don't know which one the government wants.
Whichever one pays better, maybe. Whichever one.
I'm not going there.
Sorry, I put a little joke in there.
Yeah. But you're
all
absolutely right. I
politicians are
mean,
dirty.
in a lot of areas. Sorry, go on.
I was just gonna say all politicians at this point are pretty much dirty. So
Yeah. Yeah, but I mean, in most of the areas in most of the mining areas, mining is a major employer and people want work.
and investment too, because the mining companies, what they're building, nice roads, infrastructure, schools, electricity, clean water. I mean, so the average person doesn't understand this. There's a documentary, an old one called Mind Your Own Business. It covers all this. They go and interview all the locals in Mexico or Argentina or Africa, talking about where a new mine, and they want the investment with the new schools and the infrastructure and the jobs.
Absolutely. No, that was a very good video, I thought. Or was it a video or a series, actually? Didn't they do a series
It
on
was at least a 90-minute documentary. Maybe they did additional ones.
yeah, on different areas. But you're right. I mean, the people want this stuff. And it was interesting to me that in a lot of places, even the women seemed a lot more pro mining even than the men. Um, because they know what it means. If the baby gets sick, they take it to the clinic. Well, who built the clinic? Not the government, but the mining company built the clinic.
And the electricity, the power plant, the electricity, the roads, clean water. I mean, the mining companies
Schools,
investing
yeah,
locally.
yeah, absolutely. So, yeah, you might say that the return on investment from those activities has generally not been very good for mining companies. But yeah.
So, as we wrap up here, I want to ask you about your thoughts on the gold price. I mean, the gold price could go up or down, but it looks like these central banks, they don't want treasury bonds. The macro trade, I would argue, the last 3 years is that a lot of the non-G7, the BRICS countries, they're buying a lot less treasuries or zero for some countries, their central banks, and they're buying dollar cost averaging gold tonnage. Do you expect that trend to continue?
Oh, absolutely. Yeah. Now, obviously there's a point when, it just declines, but there's still, if you look at central banks in aggregate, the foreign reserves of central banks in aggregate, if you go back to 1999, something like 76% of all foreign reserves were held in the US dollar. And the rest was spread among a few things. Some of the banks had gold, a lot of the banks had no gold, and they held German marks and British pounds and so on. Now you come, 5 years ago, that was down to maybe 65%. And now, as we know, it's under 50%. So under 50% of the foreign reserves of central banks in aggregate are held in US dollars. And gold has now overtaken the euro as the second largest reserve asset. But having said that, what does gold represent? Gold is it's something under 25%. It's between 20 and 25% of all central bank foreign reserves. So at what point does that become too much? Um, I think it could easily get to 50% before banks think maybe we've got enough gold. So the potential for that definitely remains. And if you look at why have the banks been buying gold? And again, it didn't just start in January this year. It didn't just start in 2022 with the confiscation of Russian central bank assets. It's been a longer term trend. But if you look at the last few years and say, why have the central banks been buying? They've been buying to diversify their reserves in the face of dollar weaponization. And as I just said, that has not changed. That absolutely has not changed.
Well, I would argue it's actually increasing because hasn't Trump made additional threats that if other countries start to dump more dollars or treasuries, he's going to increase tariffs and other sanctions. I think that if anything, it seems like things are headed in the wrong direction.
Well, I'm using British understatement. Yeah, so nothing that's happened this year would make a central bank say, you know what, I don't need to sell my dollars anymore. I don't need to buy gold anymore. And so I think definitely the next few years, we're going to see that trend just continue. And it'll come in ebbs and flows. China was out of the market for maybe, 4 months, and now they've been back for 7 months. It'll ebb and flow, but the trend, the direction is definitely to just keep on buying more gold.
Well, I
So
think the other issue is the size of the budget deficits and how quickly the national debt is growing, the interest payments on the debt. Because if you're another country and you're holding a lot of US treasuries, you're worried about, like, well, look, Trump passed tax cuts and he's marketing the big, beautiful bill, the tax cuts one way, but didn't it also increase the national debt massively? There's a mass amount of spending just to get the bill passed.
yeah, I mean that's always the way. When it passed the House, the spending was X. When it passed the Senate, the spending was X plus 50%. And when they had the House Senate reconciliation, well, suddenly it went to X plus 100%. It included everybody's goodie. And
And
that's
that's how the
that's the way,
sausage is made to get the votes done.
exactly, that's the way it's done. And so there is not taking anything away from Elon Musk's efforts, there is simply no will in Washington to really control a budget deficit. There's no will.
100% agree, especially when the stock market's still going up. Because I mean, like, Trump changed his policy tune. It seemed when he got in office the first couple of months, he was like he didn't care about the stock market. Now it seems like he's pumping the stock market. He's talking about how well the stock market is doing. So as long as the stock market's going up, they don't really seem to care about the amount of budget deficits and the spending. But financial history, Adrian, aren't these budget deficits? They're inflationary over the long term, right? The more the government spends is very, very inflationary.
Well, sure, sure. And the problem for the US is it's the world reserve currency, which means that, and this is why what's happening now is so critical, because with the world reserve currency, part of the deal, the French Prime Minister, what's his name, called an exorbitant privilege. The privilege part of being the world's reserve currency is that other countries will always accept your debt. Other countries will always buy your currency. And so you can print more money than you need for your domestic currency without runaway inflation. Now, if other countries start to move away from wanting to buy and hold a dollar, and they'll buy the dollar, they'll get the dollar when they do trade with the US, but they'll switch it out of the dollar as soon as they are able to. That has enormous ramifications for the US's ability to continue printing more than they need for the domestic economy. When that happens to Venezuela or Zimbabwe, the currency collapses because they're not the world's reserve currency. They don't have that privilege that other people want to buy their currency. And to the extent that we take that away from the US, I'm not saying that the US is going to lose the reserve currency status overnight, but to the extent that it loses it, then that means inflation in the US is going to pick up.
Well, those budget deficits, especially that size with the national debt where it is, the interest payments, that's historically in a lot of other countries very, very inflationary. Now, I'm not predicting hyperinflation, but I think like best case scenario, Adrian, is worse stagflation here going forward because the government is just spending an insane amount of money of currency here, and I just see the dollar being weak. I think President Trump and the Treasury Secretary, I think they want a weak dollar. Now I don't know if they'll admit that in public to everyone, but I think they do want a weak dollar.
No, you're absolutely right. They want a weak dollar, and foreign investors, sophisticated foreign investors, see that. They recognize that. So when you've had money when you've been pouring money into the US stock market for the last 10, 15 years, made a lot of money, right? And now the government comes in saying they want a weaker currency, and they don't really care whether you invest in the currency unless you want to build a factory. They don't really care about you, and they're going to put tariffs on. Your inclination, my inclination, if I were a money manager or a British money manager, my inclination would be to take at least some of the profits that I've got in the US market and repatriate the money. And you've seen that this year dramatically.
Well, I mean, the U.S. asset prices are still doing well, right? U.S. home prices in many markets, and then the S&P 500 with the Mag 7. So the asset prices are doing well. What's weak to me, Adrian, is the demand for a lot of the longer duration Treasury bonds. So I think like
Sure.
President Trump, they want to refinance at a lower interest rate. They're not getting that. I think they do want a weak dollar. So what the dollar has been off to a really bad start so far this year in 2025.
Yeah, no, they want a weaker dollar. There's no question about that.
And then they want the investment, right? So they want, I don't know if they're going to get a lot of human jobs, but they certainly want the capital investment to come back to the US. So we get the semiconductor chips and the factories. So for a bunch of different reasons.
Yeah, yeah, yeah. But all of this is positive for gold. There's nothing we've talked about that is not positive for gold.
Oh yeah, I agree. And I think it's also positive for silver and copper and to a
Yeah.
lesser extent platinum and palladium because if the gold price is going up and what some of these other metals and jewelry or investment demand or if they're lagging like when the silver price was lagging what at 20 27 28 and the gold price was soaring, I mean metals investors were looking at the metals ratios and they're going to start to move some of the capital into some of the cheaper precious metals.
Yeah, that's probably true.
Well, my contacts in China that were buying like some of they would normally just buy gold coins and bars. They told me that they were starting to move it into the other metals. So I'm just reporting what I heard from
Yeah,
other
yeah,
metal.
yeah, yeah. No, absolutely, absolutely. I mean, I think central banks will still focus overwhelmingly on gold.
Oh
Central
yeah,
banks.
I don't see anyone stockpiling any central bank stockpiling silver. There's
No.
nowhere to store it right now. There's too much.
Right, right, right. Absolutely. But for investors, yeah, no, absolutely.
Well, I think it's a question of when and not if we get gold to 4,000 then, because there's a lot of tailwinds here. And, maybe in the short term, there's a correction in the gold price if Wall Street traders like front run this and the gold price has a spike and then it sells off and there's a little correction. But all the fundamentals are all lining up for tailwinds for the gold price here. The main issue here is DC spending. I just don't see anyone cutting it. And other people that would have bought treasuries and funded these budget deficits in the past, they're just not doing it and that's going to be a weaker dollar to me and so like people are hedging the gold is basically the hedge to dollars and treasuries I would say.
Yeah, yeah, yeah. And I think the other big risk is that later this year, the Federal Reserve not only cuts interest rates, but reinstitutes QE because it becomes a buyer of last resort for the treasuries.
Oh yeah, that's a very good point. I think they already started kind of that off balance sheet with the treasury with the fiscal dominance. So the US Treasury is buying back treasury bonds in the last month or two. They started buying back a lot of treasury bonds. But Jamie Dimons even warned about this. He said, do not change the accounting laws. Do not start stuffing 30-40% of the reserve requirements for the commercial banks, the private sector banks, requiring them to load up from 10% US Treasuries to 30 or 40. I mean, he was like warning that'll hurt the banks too.
Oh, absolutely. Absolutely. No, he said he doesn't intend buying any more. But I'm sure there's some arm twisting going on.
Well, I'm surprised he's still CEO after all that's happened. I'm surprised he hasn't like said like he's leaving in 6 to 12 months and just getting out because like all the debanking stuff that's coming out. I mean, there's going to be fines and other stuff coming down the pipe soon. I'm just surprised he's stuck around.
Yeah, I can't comment on that. I don't know.
Well, it's a mess. I mean, like they were targeting political opponents, the banks, where they were
Sure.
removing people's bank accounts. They told Trump he had hundreds of millions of dollars in the bank, like Bank of America and JP Morgan. He had 20 days to move all the funds to another bank. It's
Oh,
ridiculous.
that debanking was absolutely atrocious. And it, of course, was initiated by the regulators, who would suggest, I see you've got a lot of extreme conservative bank holders. That's not a good idea. And so the banks would just, as you say, debank. It happened in Britain as well. It's to me that's just an awful thing to happen in a democratic liberal country.
Well, there's no charges yet, but the allegations, Adrian, are that they came straight from the White House. I mean, it was people like in the Biden administration, like up at the very, very top, that were threatening like the banks. So maybe the regulators instituted some of this, but they're saying like the marching orders came from the very, very top in the White House. So
Sure,
that's just very, very bad for the future of the country and the economy if like, they're going after people financially like that.
sure, sure.
Well, I really enjoyed our discussion today, Adrian. Please tell my listeners more about your newsletters and your asset management side.
Well, thank you. Yeah, the website we have is adrianday.com. And there you can find information about our newsletter. It's a more or less weekly newsletter, as well as our money management. We manage money for clients in not just in golden resources, but in global markets as well. So yeah, I invite people to take a look. And if you think it might be appropriate, get in touch.